So good morning, everyone, and thanks for tuning in to day 2 of Deutsche Bank's Global Industrials and Materials Summit. Hope everyone's staying safe and healthy. For anyone that doesn't know me, I'm Nicole DeBlaze, and I'm the lead analyst covering the electrical equipment and multi-industry space at DB. Today I'm joined by Dr. Rajeev Gautam, who served as President and CEO of Honeywell's PMT business. Very happy to have him here with us today. Prior to leading PMT, Rajeev held the roles of President of UOP, MVP and Chief Technology Officer of PMT, and he's held key roles within UOP for 30 years. I believe Rajeev has a few opening remarks, which refer to a presentation that's been posted to Honeywell's Investor Relations website. After that, we'll dive into the fireside chat. If any investors in the audience have questions, please do submit them via the box on the webcast screen, or you can also email me directly. And with that, I'll go ahead and turn it over to Rajeev.
Well, thank you, Nicole, and good morning. Thank you for having me here today. One of the strengths of the Performance Materials and Technologies business is the depth and breadth of our offerings across multiple industries. So if you can go to page 2 of the presentation, which is the first slide. As you can see from the business breakdown, the PMT portfolio is well diversified across end markets and regions. Oil and gas business, which means upstream, midstream, and downstream refining, constitutes only about 1/3 of our business. This diversity is enabling us to manage through the current challenging macroeconomic environment. While of course we have seen headwinds due to the low oil price environment, we also have continued to see strength throughout our portfolio. For example, we are continuing to see demand from our smart energy solutions in the utility sector. We have seen strong demand in our specialty product sector, including our healthcare, Aclar healthcare packaging line, and our Spectra fiber, that is the armor line. Good business and growth over there. And one of the continued benefits, of course, of the PMT business is our large install base across the portfolio. So we monetize the install base through our outcome-based software and services with recurring revenue. And this has held up pretty well through the crisis. Some hit from the slight contraction in OPEX, but by and large, and it's held up very well. And we continue to be well positioned and aligned with the mega trends. So we are actively investing in growth verticals, including connected software, renewable technologies, sustainable solutions, growing into the hybrid market for our automation business in HPS, and expanding the Solstice exposure into residential, industrial refrigeration, and e-cooling. We'll continue to focus on driving growth throughout our portfolio while we aggressively manage the cost base through this downturn and then on through recovery. If you go to page 2, now I'll touch a bit more upon these 3 growth verticals that I mentioned that we are accelerating that are tied through macroeconomic trends. Our connected software continues to be an exciting area of growth. Current estimates indicate that this year about 50% of industrial assets will be connected. We are focusing heavily on leveraging connectivity, analytics, and AI to significantly improve asset performance through predictive maintenance and reducing unplanned downtime for our customers. And we are also seeing increased interest from customers in end-to-end remote solutions and services to ensure business continuity, particularly in this COVID and post-COVID manufacturing environment. We also have a strong opportunity in sustainability in terms of renewables and overall sustainable technologies. Some are commercialized, such as our eco-fining renewable fuels technology and renewable and distributed assets project integration business in HPS. We also continue to invest in expanding our Solstice portfolio with expansion into residential, industrial refrigeration, electronics cooling, thermoplastics, and personal care. And the emerging businesses are longer-term investments. Honeywell is commercializing, for example, an energy storage battery which stores power for longer periods of time, more than the typical 2 hours shift. and are safer than the products that exist today to support intermittent and sources like wind and solar. We are also investing in the development of advanced plastics recycling technologies that make it possible to recycle plastics directly into new petrochemicals. These are exciting growth areas for PMT and will continue to accelerate our commercial traction and commercialization of these technologies. And I'm pleased to discuss the business with you, Nicole, and everyone this morning. Thank you.
Thanks, Rajeev. That was a helpful preamble. I guess maybe let's start with the impact of COVID-19. It's obviously top of mind. Which parts of PMT would you expect to be the most impacted by COVID-19? And, maybe to that same point, what parts of PMT would you expect to emerge into recovery mode first?
Yeah, good question. Something we have, thought about and are acting upon now. It's two parts to that question, if I may. One of them is the really strong, if you will, the sharp decline in demand just because of COVID-19, because nothing was moving, nothing was moving. And the other part is the price of oil. So both of them have impacted a large portion of part of the portfolio. So clearly, the lack of demand in transportation fuels, for example, and the price of oil has impacted our refining reload business. Basically, everybody froze and didn't want to spend the cash and postponed the reloads into the second half of the year. So that has been impacted. On the project side of the business, if you think of a total project cycle with engineering and licensing technology and engineering upfront, where the small amount of money is being spent as a projects business, and then if you think of the back part of the EPC cycle where the steel is in the ground and large amounts of billions of dollars being spent. So that part of the cycle, that big billions of dollars spent, those projects by and large are moving forward. There's too much invested in there. I mean, there may be one or two push-outs that we see, but only by a quarter or two while they rebid to get advantage of low prices, but that's about it. By and large, this thing is staying intact. The early phase projects are seeing a impact in push-outs because it's relatively easy to push out. This is like engineering and feed type work. So this is something people can say, well, I'll just wait another quarter or two to find out what's going on, then I'll invest. So that's what's happening in that sector. Then our automotive sector, which is impacted, fluorine products sells into that. And then the housing is impacted and metals is impacted as a result of auto. So our thermal solutions business is impacted by that because they sell burners and burner solutions into that industry. So those are the parts that are impacted. And like I said in my opening remarks, things like utility, smart energy, and our advanced materials, chemicals businesses, they are pretty much at this point not being very impacted. And when we come out of this, I think another part of the question was, when we come out of this, and we are already seeing this, as auto comes back, we had forecasted that auto would come out, like a lot of other people, that they would come out in the beginning of May. I think that got delayed by 2 weeks or so, but we see the recovery coming back. We see the demand in thermal solutions coming back, and the refining reloads, I think, will wait, probably the fall before that comes back. So that's where we are in terms of our recovery.
Okay, got it. That makes sense. And maybe just to follow up on one of the points you made around just a handful, I guess, of project push-outs. Does that mean, Rajeev, that you haven't seen any, real project cancellations so far? It's just been a few delays?
We have seen no cancellations. Just as I recall sitting here, 2 delays.
Okay, got it. That's good to hear. And then similar point, I guess on the 1Q earnings call, management noted that there have been areas of the business broadly that have seen supply chain disruptions. Can you elaborate on this a bit? And into May, as economies are reopening, have you seen this improve?
Yes, well, we did, no question about it. I think we didn't see that until March and even early April because, well, China was shut down in January and February, but the impact of that began to show up in March in the supply chains everywhere, and so we began to see slowdowns. April was pretty bad, so we saw slowdowns in our factories in China, our factories in Southeast Asia, U.S., Europe. You saw that pretty much all over the place. But we were able to operate because most of our businesses were deemed essential businesses through all of that. So we continued to operate with those challenges, of course, which were hitting us. And we tried to then work with the various governments to get our supply chain back in action. And, in cases we were successful, in other cases we were not so successful. But as we go here, we are in March, but going into May, we began to see the supply chain shaping up very nicely. And at this point, there is no supply chain disruptions that I'm aware of that we are hurting from. We pretty much recovered all of that in May.
Okay, got it. Very good to hear. And I think, as per the 1Q earnings call, the expectation is that PMT sales are down in the 15% plus zone year on year in the second quarter. And that was actually one of the better outcomes for the overall Honeywell portfolio. I guess what's the risk that the recovery could take much longer than the other segments given, oil price declines as well as just the general longer cycle nature of this business?
Yeah. So it's a good question. Again, one of the questions, as I said in my opening remarks, we really pay a lot of attention to, worry about a lot. One third of our portfolio, as I said, is oil and gas. So let me address that in the second part. I think the first part, the shorter cycle businesses are recovering pretty well. So as I said, those businesses seem to be coming back. Autos are coming back. Which means metals are coming back and thermal solutions are coming back. So I think that part is good. We saw a little bit of impact on our MRO business, but that's recovering very nicely too. So all the short cycle businesses are by and large coming back. And then the next piece of recovery is probably the catalyst reloads. But then after that, when will the new projects start? Not the projects that are already in flight, the big ones, as I said. When will they start? And that's what we are looking at, and we are planning that it will be probably next year. And why do I say that? Because, one thing is to have the price of oil so low that nobody wants to spend any money or can spend any money. That's one thing. We have gone through that period already. But if you look to the future, what will determine the spend will be not so much the price of oil, if it is 55, 65, or 75, or 45, so long it gets there and stays steady and people get confidence that this is not going to fluctuate wildly, that's when they will start moving the projects along. So we're planning pretty conservatively, saying that, okay, the price of oil may be 40 at the end of the third quarter, maybe 45 at the end of the year, and maybe get to 45 to 50 by the middle of next year. So we are planning accordingly and aligning. So maybe that's conservative, but at this point, I think that's probably best to do, so to make sure that we align our cost base with our revenues appropriately.
Okay, that makes sense. And I guess, maybe taking that a step further, it sounds to me, reading between the lines of how you've described each of your businesses and where you're starting to see signs of recovery versus where it could take a little bit longer from a longer cycle project perspective, it seems to me that there is the potential for PMC to return to year-on-year growth as early as 2021. Would you agree with that sentiment?
I won't do any forecasting here, Nicole. That's a little bit of a challenge. All I can tell you is we are planning very conservatively. We are looking at 20, but we are also looking at 21. So anything actions we are taking now, we look at the full run rate impact of that in 2021 to make sure that if we end up being flat growth or slight small growth, that we still continue to increase our bottom line. But beyond that, it's kind of difficult for me to forecast. It's very uncertain for us.
Okay, fair enough. I had to try. So I guess maybe, understanding oil and gas is only 32% of PMT segment sales. I think that's probably a bit lower than investor perception. How do you think about managing this business through a low oil price environment? And I mean, you've been within the PMT segment for a long time, albeit spent a lot of time at UOP. So maybe drawing on, what you've learned over the past downturns. How do you approach that as a manager?
Yeah, I think, in the short term, the first thing we did was just drastically shift our resources to where the business was. I mean, there was places there was business and the places there wasn't business. So, and then we had the new verticals that we have been growing, and they're not small, and they were still growing, and they're almost over $1 billion now. So we shifted resources there. So that was the first quick thing. And second thing, of course, is aligning our costs as fast as we can. We moved that. We jumped on it right away and aligned them, correctly and properly, because I knew that as soon as things began to freeze up, the inventory would start piling up and the supply chains would get disrupted. So we started aligning the cost base, right away as soon as we could. And then, we have, as we look forward here, we think that, in fact, what has happened is the renewable business, for example, renewable diesel, jet fuel business has really taken off. It's surprising, almost a lot of refiners, even the U.S. want this now, Latin America, even the Middle East, Southeast Asia. So those parts of the business are helping us get through this. So focusing on the areas where we still have business and growth, controlling our costs and the rest of the place, and then carefully monitoring our volumes and our costs in our plants to make sure that they are always aligned, because we could lose the game right there if we are not careful. So those are some of the actions we've been taking in this crisis environment that we are in. And then we've been putting out solutions that can help our customers through the COVID-19 crisis. So there are several of them we put out. One of the ones that I thought we acted very quickly was in March we rolled out a solution for remote operations and services, for example. And we stood that up in our own plant in Orange, just to provide social distancing. But then we knew that people would start limiting the number of people who could be at site in the control rooms, and how do you run your operations without engineers on site, how to protect your operators and engineers. So we created remote operation centers, virtual maintenance. In fact, we used our remote technology to commission projects during the crisis with our engineers located in Houston and Bangalore. And for example, in this case, the project was in Thailand, and that project was successfully commissioned. So there's a great deal of traction on that now from our customers. So we've been, looking at things that we can bring out and help our customers during this time of crisis, looking at areas where we have growth and controlling our costs.
Okay, got it. That makes a lot of sense. And I mean, I think investors completely understand, or mostly understand, the impact of low oil prices on the HPS business. But where I get more questions is around UOP and, to the extent the different pieces of UOP that are impacted by lower crude prices and the pieces of UOP that aren't. Could you maybe elaborate on that?
Yeah, sure. Sure. And in UOP, the piece that has the biggest impact is the midstream gas business and the shale oil space. So that was really already slowed down last year, and we had started to take action on that business last year. But this year, towards the end of the year, we booked nothing in the shale gas space, cryogenic plants, as we call them, cryos. And then this year, nothing so far. So this thing is pretty much dead and will probably continue to be dead. Permian may continue, or parts of Permian may continue, will continue, I'm sure, because they can probably operate in a $40-45 oil environment. But outside of that is going to be a little bit of a challenge. And then, as I said, we have the projects business, and there are two parts to it. Now I'll refer them to the licensing engineering piece, which is the upfront piece, and then the equipment piece. In equipment, the back end, which is tied to the big projects like HPS, those projects are moving forward. The backlog actually there has increased because those projects are moving forward. People are placing orders or have placed orders, and so that part of the business is oversubscribed. So far, the backlog in licensing engineering is very good. It's, basically we are, even in the fourth quarter, we are 70 to 80% sold out already in that area, and the backlog there is still holding strong. Going forward now, that's the part of the business that will be impacted and will recover probably more like I think some people call it a Nike recovery, if you will. over the next 2 quarters and maybe into the first part of next year.
Okay, that's really helpful to characterize. Maybe shifting to LNG, can you just maybe talk through exposure to LNG within the PMT segment and your level of concern around project pushouts and cancellations here? Or, is this an area where you think that the backlog seems more intact, more solid?
Yeah, we actually don't have that much exposure to LNG. We have some. The total exposure is roughly less than $300 million. And those projects are still all moving forward. But no question that as you go forward and look at it, LNG space has slowed down, and any new projects there will take a little bit longer to materialize maybe as people begin to rationalize. And look, it'll depend upon how fast demand comes back and what the price of gas, traded over in Asia, going to China, go to Europe, materializes at. So that will depend upon how strong LNG is. I think there are going to be some projects still go forward, but not the number that I think are out there in terms of either seeking FERC approval or with FERC approval.
Okay, understood. Got it. That's helpful. And then maybe shifting over to advanced materials. I know at last year's Investor Day, you noted that the total addressable market for Solstice is expected to expand by $7 billion. Can you give us an update on where the total addressable market sits today? And I guess, regarding the expectation for a 15% market CAGR on the slides and then same Investor Day, do you still think that that's doable?
Yeah. So just for reference, the current TAM for Solstice is $19 billion. And the current TAM is in markets like autos, OEMs, foam, commercial refrigeration, chillers, etc. And we expect this TAM for Solstice to expand by another $8 billion, driven by growth in the auto aftermarket, non-regulated vehicles, U.S. residential and DRF, industrial refrigeration, electronics cooling, thermoplastics, which is an area where foam blowing agents give really good properties, and personal care, and pharma. So these are areas where we should continue to see growth, and we expect to achieve Solstice sales with a 10 to 15 CAGR over the strat horizon.
Okay, got it. And has that business at all, the trajectory maybe, been impacted by weaker auto sales in recent quarters, or has this been an area of strength?
No. This no question. It was impacted by autos for sure. They slowed down, as I said, completely in March and late March, early April, complete slowdown, and then recovery in May. So we were definitely impacted, and our demand in that area dropped significantly. No question. But as I said, the autos are recovering. How fast will they're recovering actually quite nicely and sharply. The question really is in all of this, which I don't know, and that's why we have been conservative in our forecast, is, will this get back to the 2019 level? On how fast? I'll let people who are better prognosticators than me, come up with the answer to that. I'll just plan conservatively to say it will be a slower than we're seeing pretty fast growth, but we are not standing up and celebrating.
Yeah, makes sense. That's the $1 million question. Okay, so maybe shifting to connected. I know you talked about this as one of the areas where you're making investments. Can you maybe give us a sense of the revenue contribution to PMT today and, how fast this is growing or some sense of where this could go in the future?
Yeah, this is a really strong area for us. A lot of our customers, they were already into our advanced solutions, but now with the connected, how easy it is to be connected, this has really taken off. As I said, 50% of our customers will be connected by the end of the year. So our software sales today, our connected software sales today are about roughly, call it around $400 million, roughly, with a total software sales of roughly about $1.3 billion. The difference is our embedded software. So that's the scale of our business, and we certainly have plans and expect to grow this revenue double digits CAGR over the next 3 years. And while most of our businesses have a software component, a lot of this is in our automation HPS business because they're already connected. So it's a lot easier to use that channel to provide connected solutions, and our customers are used to getting those solutions in those channels. So we have been providing solutions to significantly improve asset performance through predictive maintenance and reducing unplanned downtime for our customers. Good traction on that. And then now as we go forward, remote solution services seems to be getting a tremendous amount of traction.
Okay, that's really helpful. Thanks, Rajeev. And then maybe shifting to some of the cost savings that Honeywell's guided to. I think for the total company, we're looking at phase one savings of about 1.1 to 1.3 billion, with a potential phase two being mostly permanent and the first phase being more short-term in nature. Can you give an update on where PMT is in the phase one process?
Oh yeah, I mean we like all the other businesses. Honeywell have a phase one plans in action. They're finalized. They're moving and have been moving for some time. So that part, both our temporary and permanent cost actions are in place and in flight, and in line with the figures that Honeywell has put out and highlighted at the investor call. And as I said, we moved quickly to implement this to right-size the cost base. But unfortunately, I just don't know how to predict the price of oil. Well, we do have a prediction, but you know how that goes. So there are people who have theories that the price of oil could recover faster, and in fact seems to have been showing that it's recovering quite fast. I think some of that is okay because the demand for jet fuel and diesel and gasoline was so far down that there is a fast recovery. Look at how fast people hit the roads, right? So that is, yes, I can see some of that, but long term, I think our forecasts are still valid. So we're going to still plan very, very conservatively, as I said, as we look at a cost base.
Sure, definitely makes sense to go that way. And maybe, hitting on the investments and opportunities that you brought up in your slide presentation at the beginning, what do you think if you were to look at, what's on the slide, what's the most promising or most imminent investment opportunities?
Okay, so the good news is there are several of them that are in flight and making us good revenues. Renewables, eco-fining technology. We developed it many years ago. We helped commercialize that. It's the first of a kind technology. We were the people who helped commercialize it in the world. So finally it's hit and it's got really good traction. Solstice, of course, on the sustainability side, continues to go. And the connected software, I said, that thing is going very well. And we are developing more products which are tied to the areas that I described, product connected worker and the connected plant areas. So those things are going well. The two new areas which are pretty exciting are in the areas of renewable power. So this is where we are developing a battery. Today's batteries, yes, they're commercial. They're based on lithium ion. They generally shift power for about 2 hours. If you want to go more than that, the cost begins to escalate, and of course, there is an issue about safety that you got to deal with. We are developing a battery that can shift power 4 to 8 hours. It's not lithium ion, and it will allow a great deal of flexibility at the grid level to a lot of producers of solar and wind. So that, along with battery management systems and EMS systems, is an area that we are investing heavily. The last piece is also very exciting is in the renewable plastics, and not renewable plastics circularity and recycling plastics. We supply a lot of technology into this area, and we have expertise in plastics as well as in refining technologies. We use a lot of that, like we use pyrolysis technology for renewable fuels. We use the FCC type technology for renewable fuels. So we are using all that know-how to develop a process which is now in commercialization phase, which will convert plastics into a plastic oil, which can then be actually fed into an ethylene cracker to make ethylene or into a propylene to make propylene. So this is pretty exciting. We are bringing this out in two parts. One of them is a smaller 30-ton facility and a 200-ton, 30 kMTA facility and a 200 kMTA facility, all modular. We expect the 30 kMTA facility to be closer to the recyclers and the 200 kMTA to be closer to the producers of plastics. So it's pretty exciting, and we're really moving forward on that.
Yeah, that's a great list, Rajeev. All really exciting stuff. So I know we're running short on time here. We probably have time for one more question. We spent a lot of time talking about, the growth opportunities, top line. When we look at PMT margins, they expanded to 22.5% as of 2018. How do you think about the potential for margins to continue moving higher from here? And is that doable in a lower crude price environment, or do you think that will be challenging?
No, it is very doable. I mean, in fact, as you probably know, in the price of oil, our margins and our customers' margins are not that driven by the price of oil. It's of course the margin between the price and the supply that matters. Some of the refiners are actually making good money. Those who are producing are making good money, and they were, and I think they will again. But that just says that our environment will improve. But for us, our margins, yes, we can grow, no question about it. We have had that confidence. One, because of the new verticals that we have made a great deal of traction in. We've been talking about this for some time, and these are all high margin, high growth businesses. So as they become a larger part of the portfolio, and we are, as I said, we are already over $1 billion in this area. And that's 10% of our business, and it will continue to grow double digits. So you can see that this will impact it. But then you take our SME business, when we took that business, we fixed it. We're getting margin expansion in that. Our HTS businesses, in our LSS businesses, as we grow into more enabled services, we're expanding margins. In our Lifecycle Solutions, the catalyst business, as we go into more outcomes and connected services, and we're getting good traction on that, we're getting better margin. So this aftermarket and monetizing it as recurring revenue is really giving us another source of margin expansion. So yes, we expect margins to continue to expand over the strat horizon.
Got it. That's great to hear. Okay, so I think we should go ahead and wrap it up there. I think we're coming up against time. Rajeev, thank you so much for your participation today. This has been a really insightful session. And thanks to everyone in the audience for tuning in.
It's been a pleasure. Thank you.